Hello, everyone. It's Tuesday, October 18th. Today, we'll be talking with Dana Lyons from J Lyons Fund Management, Chicago. We'll get a couple charts that he is using to put things into proper context. Another choppy session, but netting out to a decent move for the S&P. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a smoky Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets. Using the power of StockCharts, our tools, education, and commentary are really designed to help you try and make sense of the markets in uncertain times. I always introduce the show with an adjective to describe the conditions around Redmond. Smoky is the word I would use. We have wildfires that are raging around us, so it's pretty tough outside at the moment. But hopefully, rain come. I can't believe in Seattle we're hoping for rain, but that's actually where we're at right now. And it's funny when you think about these uncertain conditions. That's reflected very much in the market dynamics as well. Yesterday, today, kind of a similar thing. We have a big gap out of the open. It's happened a number of times in the last week. But then kind of a choppy sort of range-bound day when all is said and done. We'll look at the charts here in a few moments. But I did want to let you know about the upcoming guests. We have Dana Lyons today, who's been on the show many times, always brings some really good thought-provoking charts. You won't be disappointed today as well. Tomorrow, on Wednesday the 19th, we have Hema Reddy, who's an author and educator focused on GAN analysis, which we've not had often on the show. So I'm interested to hear her take on the current markets. On Thursday the 20th, Jeff Huge coming to us from Minneapolis. Jeff has a wide following in the institutional community, always interesting. And then next Tuesday, Bruce Frazier, the professor, coming to us from Reno, Nevada, and giving us some taste of the market using the Wyckoff method. I want to continue on today with our market recap. Let's break down what happened and how the charts have evolved from yesterday. But I do want to start with a poll. We always have a poll going on our live stream page at StockCharts.com. Also on our social media accounts. So give us a follow on Twitter at FinalBarSCTV and subscribe to our YouTube channel. You won't miss another one of these. We asked you recently, how often do you use point and figure charts? I thought of this because Bruce Frazier is coming on the show next week. When he was in town for ChartCon, we talked about point and figure charting, which is an integral part of the Wyckoff method. We don't feature point and figure charts often on the channel. We talked about some ideas about how to upgrade our educational components along those lines. It's a really fascinating toolkit. Most of you, actually, that's not true. 36%. The biggest response was a couple times a month in terms of how often you use point and figure. Very few of you refer to it every day, and about a third of you apparently don't know what a point and figure chart is. So I'm a little disappointed by that. I will try to do better at introducing you to this point and figure method. And what's fascinating about it, just to go to the charts here, where you have sharp chart, which is how you probably normally bring up a stock, or you're on ACP when you're bringing up a chart of a stock or ETF. If you go to point and figure, you'll get to our point and figure engine. Point and figure engine. It is a really interesting set of or visualization, really, that came from the floors in Chicago, is how I would describe it. And that was certainly how I was introduced to it, which is traders that would go and look at the high and the low every day and then hand update their point and figure charts to track where things were going. I remember sitting down with Louise Yamada years ago, and she unwrapped these big, huge paper point and figure charts that she was updating for the Dow 30 stocks for like 30 plus years. And it's a very simple but powerful method to track trends. And when you're seeing stocks bouncing off of the lows like you're seeing with Apple, the question is, can it generate a buy signal, which it's not quite done. It needs to get up to 148 to be able to do so, very close, but not quite there. If it does, that would generate a point and figure buy signal. Might be an interesting toolkit to look at right about now. Let us continue on, though, and look at the market recap. As I mentioned, choppy session, and this is one of those interesting patterns that we've seen a lot, I would argue, in the last week or two, where you have a big move out of the open, but then in the end, we don't really go any further than that. A gap higher with the S&P opening up just around 3760, but for the rest of the day, really chopping around between 3700, we'll call it, and 3730, finishing the day almost right in the middle there, up about 1.1%. from Monday's close. The NASDAQ up 0.9%, mids and smalls both outperforming the S&P. The mid-cap index was up almost 1.5%. The VIX down a bit, still above 30, and that 30 level is sort of that big line we have on our chart of the VIX, just tracking whether we have excessive volatility or not. I would argue above 30, still I would label it as excessive volatility or unusually high volatility relative to historical trends, particularly in this year. Interest rates, another sort of choppy day in the bond markets with the 10-year yield moving higher up to around 4.06, but finishing the day right around 4%, which is, again, a key level. It's fascinating how we've been chopping around this 4% level. Could the market, could rates go much higher than this? Of course, theoretically, they could actually go exceptionally higher than that. And when we have the wide shot, and you can see the charts behind me in my office, you'll note, may not be able to see it particularly well, but one of them is the 10-year yield going back to like 1970. And I have that on my wall to think about the long-term uptrend in bonds going into our long-term uptrend in rates going into the 1980s, the long-term downtrend in rates, the long-term bull market in bonds going through recent history, and then in the last 3 to 5 years, really this transition from lower rates to rising rates. I don't think rates are done going higher, but I could certainly be wrong. However, think about if rates continue to go higher, what stocks, what sectors, what themes will tend to thrive in that environment, what will tend to struggle. Dollar index, not much different than yesterday, really sort of chopping around the zero level at the end of the day. Gold and silver, barely in the green, everything else in the commodity space negative. That's using the commodity ETFs that we tend to track. And 9 out of the 10 of the most liquid cryptocurrencies that we track, all in the red today, not down by a ton. So Bitcoin only down about 1.4%, but being repelled from that 20,000 level, sort of attempted over the weekend to sort of get above there, reverting back to the downside, and Ether back down to 1,300, which is a key level we've talked about for quite some time. So what did today's move do to the chart of the S&P 500? I did a webcast earlier today for market misbehavior, and we were talking about seasonal trends. We were mainly talking about a market bottom checklist and going through 10 steps to track to identify when a bottom may be in. And I'll share with you 3 of them right now, because looking at a chart of the S&P, they almost jump off the page of me. One of them is a bullish momentum divergence, which is where you have lower prices and a higher momentum rating, ideally oversold the first time and not oversold the second time. That is what we see on the chart of the S&P 500. It's what we see on the chart of the Qs. That's what we see in a lot of individual stocks like Microsoft and many, many others, too many to probably name. We had lower lows going from September into October for a lot of stocks and a number of ETFs. But for many of them, they're showing a bullish momentum divergence with less negative momentum on that second drop to new lows. That suggests potential exhaustion to this downtrend and potential upside to be had. Now, 2 other items on my market bottom checklist were the S&P making a higher low and the S&P making a higher high, and neither of those has certainly happened, right? The most recent low was down just below 3,500, which for the record is a 50% retracement of March 2020 to January 2022. Key level, not surprising, I don't think, to see a bounce off of that point, just like it wasn't surprising to see all of the bounces off of 3,800, where that became a key level over the sort of spring summer period. We also have not seen a higher low, right, or a higher high, right? The most recent upswing in early October was this gap higher to around 3,800, and then the gap lower. Call that an island reversal pattern. We have a gap higher a couple days, and then you have a gap lower, and sort of this price action separated from the mainland there. That continued lower for the next week or so. From there, we've came back up, but we're not above 3,800 left yet. That happens. The S&P gets above 3,800. The S&P makes a higher low. The bullish momentum divergence follows through. That's when you will hear my tone and my approach become a lot more constructive, particularly on that shorter term time frame, because it shows you that buyers are not just quickly pushing prices higher, but that it's something more meaningful and more significant. Until then, I don't think I could feel comfortable making that sort of claim based on what I've seen so far. Just to finish off the market recap here very briefly, industrials and materials and utilities, top of the list, with industrials leading the way higher, up about 2.5% today. Lagging behind, and all 11 sectors were positive, but healthcare only up about 0.6%, followed by communication services and technology, all up less than 1%. So an interesting sort of cyclicals over growth is the general way I might describe the behavior of the market here. Just to finish off, look at the cruise lines continue to pop up here. Now, again, it's interesting when you look at a chart of Royal Caribbean or Norwegian cruise lines. Are these impressive bounces off the low? Absolutely. This is a stock that's gone from 11 to over 14 in a couple of weeks, right? That is a decent move higher. But has the trend in this chart really changed yet? And I would argue 100% no. Have we made a higher low? Maybe, right? To sort of think of this as a retest of the 11 level. The bounce off of there is good. Getting above the 50-day moving average is good too. Getting above that high from September, getting above the 200-day, that's when this chart really starts to change character and shows you that there may be staying power to the upside. Let's take a quick commercial break. We'll be back with today's guest, Dana Lyons. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we try to make sense of these markets using the technical analysis toolkit. A couple quick announcements before we bring on Dana Lyons, today's guest. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We'd love to feature one of your questions in our next mailbag segment on Friday's show of this week. You can email us your questions at thefinalbar@stockcharts.com. We are on Twitter at FinalBarSCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We have so much great content every trading day. Great guest experts like Dana Lyons, Katie Stockton, many others that we've had on the show in recent weeks. Special events like Larry Williams' Market Outlook, which you just put out about a week ago. All are available for free at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Dana Lyons. Dana is the partner at J. Lyons Fund Management, editor of the Lyons Share Report, coming to us from Chicago. Dana, great to see you. Welcome back to the show.
Thanks, Dave. Always great to be on your show.
When I think about your our previous discussions, Dana, I think about some really good thought-provoking charts, and you didn't disappoint. Your first one, I'd love for you to talk us through these two series and what they tell you. What is this suggesting?
Sure. Well, when I come on your show, I always like to bring one shorter term, kind of an actual chart, and also a longer term type of big picture chart. And this is the big picture chart. Kind of shows where we are from a risk standpoint in the big picture, not an actual chart necessarily, but how much risk is there in the long term embedded in the system? And this represents the market cap of the U.S. stock market to GDP, also known as the Buffett indicator, which some of your listeners may be familiar with. So it's kind of a measure of valuation, how extended, how overvalued is the stock market or undervalued. And if you look at it versus the red line, which is the forward 10-year return in the S&P 500, there's an inverse relationship. So when the ratio is high, forward 10-year stock returns tend to be low and vice versa. That red line is inverted, by the way. So for example, in the mid 60s, the ratio got very extended. Also at 2000 set a record at about 150, 160% of market cap to GDP. And you can see the forward returns in the S&P were about zero and that's over a 10-year period. Well, recently we actually set a record surpassing that 2000 high. We got up to over 200% of market cap to GDP. And that obviously from a historical basis signifies just a lot of risk embedded in the system. And while we've come down this year already, it's only down to about 150, 160%. So right back down to that 2000 top, which was the previous record. So I guess overall, the takeaway is while there's been pain this year in the big picture, there's still a lot of risk embedded in the market.
It's such a great chart, and I love thinking about where we're at right now using this particular evaluation method versus some of these previous market peaks. It's a good chart to think about. Your next chart, Dana, is looking at The NASDAQ 100, looking at some Fibonacci relationships. Talk us through this one.
Yeah, sure. This is the shorter term, more trade oriented or actionable chart. So it's important to have a durational perspective. So the prior chart was big picture, long term, which is not that rosy of a picture. In the short term, we might be able to, despite the weakness this year, we might be able to mount some sort of a bounce or a rally here. When we're looking for possible reversal junctures in the market, we like to use Fibonacci, which is a technique, a mathematical technique that shows you potential retracement periods and or junctures. And the two most important ratios are the 61.8 and the 38.2% retracements. And looking at the NASDAQ 100, we see both of those, the 38 retracement from the 2002 bottom and the 61 retracement from the COVID bottom in 2020, both line up around 10,600, which is actually right where the NASDAQ 100 closed last week, which is one reason potentially why we're getting such a strong start to this week. And as long, I would say, as long as that level holds, we might get some more bounce potential temporarily. Again, I don't want to confuse this with a longer term bullish view, which we don't have, but in the short term might be a good line in the sand to trade against on the long side.
So when you look at this market, obviously, I mean, it's been a challenging year for a lot of investors, Dana, but now looking forward through year end, you know, the seasonal trends would suggest to us, kind of along the lines of your second chart, seasonal trends actually tend to be pretty strong, right? November, December, actually usually pretty decent, particularly in the midterm election year. If we do see that kind of short-term strength, but overall, if we're still facing these larger headwinds, how do you position yourself going forward here through year end to try to navigate that period?
Right. Again, it's about durational perspective. You know, you have to separate a trend or a trade from a long-term trend. And I heard you discussing the long-term trend in your intro to the show. That's an important perspective to have. You could have significant bounces, you know, within a bear market, like we saw off of the June low, that end up just being bear market bounces. They could be significant, especially in something that's beaten down like the NASDAQ 100 and tech and growth. But it doesn't mean it's changed the trend. It doesn't mean you can buy and hold and not manage risk. You still need to manage the risk. So having a line in the sand like that 10,600 level on the NASDAQ kind of gives you a stop loss. If we do decisively break down below there, then you have to say, okay, maybe that's not going to work. Or on the upside, you have to have some price targets where you're going to take some profits. So in our management style, we do have risk models that we use where they have to line up with the technicals, with the Fibonacci's, for example, to suggest, okay, maybe this bounce is shaping up to be something more sustainable. If that doesn't happen, then we're looking at this as just a trade on the long side.
It's I really appreciate you talking through all that. You do a great job, Dana, of thinking about the risk management side. Certainly has served investors well in 2022. Stay safe there. Be well in Chicago. We'll talk to you again soon.
Sounds good. Thanks, Dave.
It's Dana Lyons. Dana is a partner at J Lyons Fund Management, also editor of the Lyons Share Report. We were talking before we started the show about just risk management, and 2022. If there's been a year to focus on risk management and lines in the sand, as Dana put there toward the end, this has certainly been it. And I like that comment because as we mentioned in the market recap, we're seeing some short-term signs of appreciation. Right, we've seen some bullish candle patterns in the last week. We saw bullish momentum indications, as we saw with the S&P, with Microsoft and others. But at the end of the day, right, the question is how that fits into the big picture, and having a level, having a line at which you agree that no matter what you're thinking might happen or could happen, you decide to make a change or revisit a position. I think that can serve you very, very well. Great take there from Dana Lyons. Really appreciate him coming on the show. Let's continue on our show with the Final Bar Mailbag. As a reminder, we're always here for your emails. The Final Bar at StockCharts.com is our email address. And let's get to question number one. Dave, what do you think about the weekly RSI divergence? When we have a divergence, what is usually the price target Really good question. Let's look at that. So this is looking at the weekly S&P, and I think this is the chart you sent. I didn't jot down which chart. The person that asked this question, I apologize for that. But I thought it was the S&P or something close to this. I mean, it might have been the NASDAQ or something. And I think you're talking about this momentum divergence. So we talked about in the market recap the daily chart and how we were seeing a bit of a divergence, which is when price goes lower, but the momentum is actually trending higher. You're seeing kind of a similar thing on a longer term basis on the weekly chart, right? If you look at the weekly S&P chart, you have the low in June. We undercut that obviously with the low in October. But if you look at the momentum right at the oversold level there in June and above there, right? Just above, just below 40 on the new low in October. So yes, I would absolutely say that is certainly a bullish divergence. What does that tell me? That tells me to start to be skeptical about further downside, or look for, I guess a better way to put that, look for signs of a rotation. Divergences are a leading indicator, and that can be very helpful. However, it also can give you false positives or false negatives, I guess is how to put it. And there are times when you get a divergence that doesn't really play out. A good example of that, just looking at the weekly chart of the S&P, I don't have a good example readily available, but this is pretty good. Look back in 2017 when you had the high in February, then you had another high here in June, right? Pull back a little bit. It's hard to tell on this chart because we've gone so far, but at the time looked pretty good, about a 6-month period. Higher highs in price. Look at the momentum, which actually went lower, right? You had overbought here and then not as much here in June, July. That was a bit of a bearish divergence, but if you look, the market just kept going. Once again, became overbought. And I think that's the risk when you get some sort of divergence in an uptrend, is that, it's a brief pullback, but then just, lights out, continues to go to the upside. That's the danger on something like this, that it's a brief bounce, sort of a dead cat bounce, and then you go lower. So 2 ways I would think about it. Number one, focus on it as a leading indicator, right? It's something that should put it on the list. This may be a reversal I'm going to look for. Then develop some levels, some guideposts, a line in the sand on the upside that would tell you to confirm that rotation is already has actually played out. So the leading indicators definitely triggering. The lagging indicators, I would argue, on the weekly chart, certainly not indicating any kind of strength just yet. What kind of things could you look at? The weekly PPO or the weekly MACD come to mind, a simple moving average crossover system, maybe even on the daily charts to look for some sort of rotation higher. That's what I don't think we've seen yet on this chart of the S&P. What is usually the price target? I wouldn't use anything related to the divergence to develop any sort of price targets. What I would probably do is look at Fibonacci retracements, which is what Dana Lyons mentioned. So I think just like the Fibonacci levels have been meaningful, and I think they've been very, very helpful on the way down, particularly if you look at March 2020 and January 2022, it basically told you 3,800 and 3,500. And so far, those have been pretty decent downside targets for the S&P. I would be looking at those on the way back up, which means 3,800, a really good starting point. We get above there, then we start looking toward previous highs, maybe 4,300, which would be the August peak. Great question there, by the way, and thanks for sending that in. Next question. This is like the big picture question week for some reason. A lot of times they're a little more granular. These are more broader scope. Do you think we are in a cyclical bear or a secular bear market? So, to be clear, we could actually be in both, right? I mean, you can either one of these are sort of binary, and arguably in some ways you could think about a little more nuanced than that, right? We love to think of simple, right? Are we in a bull phase or a bear phase? In reality, you have to remember that a lot of times the market goes that third direction, which is sideways, which is really frustrating and really painful. But if you look at 2018 on the left side of my weekly chart of the S&P, it was basically an expanding pattern, right? We hit a certain point in January 2018, January 2019, we're at the same level. We just spent a year with these painful upswings and downswings, but directionally, did we get anywhere? No, we really didn't make any progress. And soon after, we're in 2020 and right back at those same levels. How would I label this market? I think at this point, I would clearly label this as a cyclical bear market. I don't think that's necessarily debatable at this point. I mean, someone probably is trying to make the argument that it's not, but I don't know what I would see that I've not seen already to determine that this is a cyclical bear market. And for me, it's enough when my market trend model is negative on all 3 timeframes, particularly the long-term timeframe. That's what confirms to me that we're certainly in a cyclical bear market. Secular bear is tougher, and I think it's way easier to figure out secular markets way down the road, right? So in the rearview mirror, it looks really easy to pick out the 1970s and the 1980s and 90s and the 2000s. I will tell you, in the heat of the moment, we don't invest on the secular time frame very much we do in a retirement account, but day to day, we're focusing really on that cyclical time frame or probably shorter. So having said that, I would argue we're probably still in a secular bull market, but there's some painful drawdowns that can happen, and that's what we're finding now, right? How does it make you feel better to know that we're in a secular bull market or bear? Like, I don't know if that would change how I'm positioned or how I'm approaching the world right now. I'm focusing on the trend. And to me, that intermediate long-term trend, very much negative. And that tells me cyclical bear, very much in case. Last question, probably, and then we need to wrap the show. I've noticed that the small and mid caps are currently outperforming the large caps. Does this have any meaning or insight as to what's going on under the hood of the market? I love that question so much. So in my Mindful Investor Live chart list, which we're looking at here, which I often refer to, this is one of the charts in there, which is literally the ratio of smalls versus large. So it's the IWM, which is the Russell 2000 ETF, versus the S&P 500, the large cap ETF. If this line is going up, small caps are outperforming large caps. If this line is going down, small caps are underperforming large caps. Now, the anecdotal sort of general, principle of small cap performance is, I would think of it as a sign of optimism or pessimism, right? If investors are optimistic and they're willing to take on additional risk, they're probably putting positions on that are higher beta, higher risk, more speculative, and more likely to be small caps, which is why small caps tend to perform well coming out of a bottoming period. When investors start to get nervous after a long bullish run and start to take bets off the table and get more defensive, small caps start to underperform as investors rotate to more defensive areas of the market, blue chips, value-oriented sectors with less small caps. However, what I just explained did not do particularly well because 2021 was a fantastic year for the S&P and the NASDAQ, and small caps dramatically underperformed. This is because the FANG stocks were dominating during this period. In the first half of 2022, small and large caps were really in locksteps, kind of chopping around, but in the end, no real definition. I would argue in the last week or two, we're starting to see small caps really complete that rotation back to the upside. We could be entering a period where small caps outperform. My basic playbook would say that's probably a sign for optimism, but I'm skewed a little bit by what's happened the last couple of years where there have been other times where other cap tiers are leading just fine. We need to wrap the show, folks, and go quickly to the 3 and 3 charts in 3 minutes that tell the story of this market environment. Here we go. Chart number 1 is the Bullish percent index. I mentioned point and figure charts. This is a breadth indicator designed to be used as really a derivative of point and figure charts. This looks at all 500 members of the S&P. For every one of those 500 charts is the most recent signal a buy signal or a sell signal using the traditional point and figure methodology. Recently, it was down to about 10%, meaning 90% of the S&P were all in a sell signal, according to the S&P, according to their point and figure charts. That has now reverted back above 30% as of today. So the only 2 other times that has happened in 2022 was in May and in June. And in both of those times, we had a decent tradable bounce, the rally in early June from the first time, and then the rally July and August in the second one. I'm getting that same pattern here. So again, with these divergences and these breadth indicators turning higher, I'm getting signs of short-term rally mode, and it tells me to start to think about the potential of that being a likely scenario here going forward in the coming weeks. Chart number 2 is Royal Caribbean. When I'm noticing on the daily movements and I'm seeing the biggest gainers in the S&P have been cruise lines a number of days in the last week or two. RCL, NCLH, CCL, all on the top 10 list, if I remember today, in the S&P 500. Let's look at a chart of RCL briefly. After bottoming out in July, it moved higher to around 52.50 in mid-September. That represents a 38.2% retracement of that big sell-off from April to July, which means as we're rallying back up, I think I'm focused very much on that 52.50, 52.70 level. That breaks, then we can start thinking about further upside. But let's get above that previous high first. Finally, the chart on Netflix. I'm looking at all these stocks that are potentially, reverting back to the upside. I'm seeing signs of strength, but I would be much more optimistic if a stock like Netflix would not just hit 250, but would actually break above there. That's what I would argue we have not seen yet. Are names like Netflix really demonstrating that buyers are not just pushing it up to resistance, but pushing it through resistance? That would be strong upside momentum. That's what I'd be looking for here. Folks, that's a wrap for this show. I want to thank Dana Lyons joining us from Lyons Fund Management in Chicago, sharing some great long-term charts with us. All of our previous interviews are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.